Is your American dream about to turn into a nightmare? The truth nobody's talking about. Is history repeating itself? Why did 5 major banks collapse in just 1 month? Have you kept up with the latest news? If you've been paying attention to the current state of bank loans and mortgages, you'll notice a huge shifting financial landscape in America. Behind the glossy brochures and open house smiles lies a brewing storm. Today in this video, we'll dissect the shifting financial landscape, revealing the cracks in the mortgage system and the rising tide of uncertainty drowning homeowners and investors alike. Let's see why it's happening and ways to protect yourself from this upcoming crisis, because this isn't just another financial blip on the radar. This is a potential tsunami that could reshape your way of life. So be sure to subscribe to our channel to stay up to date on how to keep your finances safe. We're all aware of the ongoing recession, and its impact is evident with more business closures, rising unemployment, and a decline in the gross domestic product. Despite our hopes for better days, it's important to recognize that recessions are a natural part of the business cycle. The duration of recessions varies, and over the past 2 decades, the U.S. has experienced downturns in 2000, 2007, and 2020. While the typical cycle suggests a recession every 7 years, the current downturn from 2020 to 2023 doesn't actually go with this timeline. The financial world is inherently unpredictable, as seen in historical instances like the back-to-back recessions in 1980 and 1981. And as Jim Rickards warned us, the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down easily, go down 30%, and it wouldn't shock me if it was down 50%. You're looking at, S&P, 22, 100, something like that. Now, there was a brief 2-year break between 2020 and 2023. However, the unfortunate news is that 2023 brings not just a recession, but also an impending financial crisis. This crisis is looming, causing a panic. If it does strike, the impact is anticipated to be severe, signifying a truly dark day for both America and the global community. Each financial crisis brings its own level of impact, some resulting in substantial losses, while others may have lesser consequences. Here's the thing, according to Jim Rickards. People need help to accurately predict whether a crisis will be small-scale or large-scale, or how quickly it'll end. Jim Rickards suggests that predicting the scale and duration of a crisis can be challenging, and sometimes a financial crisis coincides with a recession, resulting in a genuine disaster. One historical example is the subprime mortgage crisis of 2007 to 2008. The expansion of mortgage credit during this period allowed easy access to borrowing and mortgages. Unfortunately, this led to a bursting of the housing bubble in the U.S., causing a significant decline in home prices. The aftermath was devastating, with many people losing their homes, savings, and jobs. Since the U.S. is at the center of global trade, the impact of this crisis reverberated worldwide. We've been talking about recession, inflation, deflation, but the one thing we haven't spoken about yet, you kind of just referred to it, is there a global liquidity crisis coming? Let's say there was no recession, the economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. So one very important aspect we haven't touched upon yet is the possibility of a global liquidity crisis on the horizon. During the 2008 crisis, industrial production saw a global collapse, credit markets froze, and commodity prices plummeted. This crisis resulted in a loss of over $2 trillion in global economic growth. According to Jim Rickards, a comparable situation occurred only during the Great Depression during 1931 and 1933. That period witnessed multiple bank failures, consecutive devaluations of currencies, and a general shutdown of the world economy. The echoes of such financial upheaval had far-reaching consequences in those unfathomable years. But here's the intriguing part. History might be on the verge of repeating itself. Consider the scenario. What if 2023 marks the beginning of a collision between a financial crisis and recession, same to the one observed in 2007 to 2008? This isn't mere speculation. Financial experts such as Jim Rickards have explicitly noted that the signs are already present. So what are the obvious signs? Firstly, there's the concerning trend of diminishing world trade. The World Trade Organization anticipates a worsening of global trade conditions in 2023. Additionally, industrial output continues to decline daily, accompanied by a simultaneous rise in unemployment. Adding to the economic complexities are the highest interest rates in American history, currently at the highest level in 15 years. The federal government has implemented these rates as a strategy to alleviate inflation. However, despite these efforts, inflated prices of goods and services are here to stay, putting continual strain on salaries and wages. I think they will. We can come back to that, but okay. So the inflation sort of came on the scene in mid-2021, the summer of 2021. By the fall, it was very high, and this is when JP was saying, transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, time to retire the word transitory. And then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was 0. Today, it's 4.25%. It's going to go up another 50 basis points on December 14th. If there were any doubts about the onset of a recession plus financial crisis, a look at the current state of banks in America dispels them. In just 1 month, 5 major banks have faced great setbacks. Silvergate Bank, valued at over $5 billion in 2022, declared bankruptcy on March 8, 2023. Following suit, Silicon Valley Bank, due to a financial crisis stemming from poor management, was taken over by the FDIC on March 10th. Signature Bank became the third casualty in March, officially taken over by the FDIC on March 12th, after a bank run triggered its collapse. First Republic Bank also found itself on the list of failed financial institutions, rescued from a $30 billion liquidity crisis by 11 banks on March 16th, having lost around $70 billion in deposits. Lastly, Credit Suisse, one of the largest banks globally and the second largest in Switzerland, collapsed in March 2023, necessitating its acquisition by rival bank UBS for $3 billion. Astonishingly, these 5 bank failures happened within a span of just 1 month. As per Jim Rickards, the collective losses suffered by credit and stockholders of these financial institutions surpassed $200 billion, which is a concerning downturn. These bank failures have delivered a powerful message to the public, indicating a genuine problem in the current financial system. Consequently, people are now increasingly panicking. In an attempt to mitigate this panic and assure the public of the safety of their funds, the FDIC is resorting to unconventional actions to regulate these banks. Let's see how. Here's a little breakdown. After the March 2023 bank failures, the FDIC did something unusual. They promised over $200 billion in insurance deposits to all depositors of Silicon Valley Bank and Signature Bank. This is way more than the usual insurance limit of $250,000. It might be good for depositors right now, but Jim Rickards thinks that it will end up draining the FDIC insurance fund, putting the financial burden on regular people at the bottom of the economic ladder. Adding to the mix, the Federal Reserve is offering more loans to member banks through the Bank Term Funding Program, BTFP. Jim Rickards suggests that the total amount for these loans could go beyond $1 trillion. These moves have really shaken up the U.S. banking system, leaving everyone, especially depositors, confused. People are wondering if these actions signal a new policy or if they're just rule-breaking responses influenced by the problems faced by a few big players hit by the recent bank troubles. You're working with the FDIC, and ShieldBearer and others guaranteed every bank deposit in America. They didn't have to do that. We had a $250,000 insurance limit, but some, small businesses might have $1 million in the bank. So they were pulling the money out of the bank. So Bernanke said, forget that, we're guaranteeing everything. That was in 2008, right? Has the government overlooked the fact that U.S. bank portfolios are now carrying unrealized losses exceeding $700 billion? If, amid all this chaos, the U.S. government keeps handing out cash to depositors from its own funds, the banking system is at risk of collapsing. While their actions aim to reassure people that the banking system is safe and secure, is it really the case? Have they truly convinced us that everything is fine? Most importantly, is the crisis over? The answer is no. In fact, the panic is just starting. Recall the 2008 financial crisis we discussed earlier, which bears similarities to what we're witnessing in 2023. That crisis began in the spring of 2007, when HSBC announced that mortgage losses had surpassed expectations, triggering a major panic and setting off a chain of events leading to the financial crisis. Significant moments during that time included the failures of financial institutions like Bear Stearns in March 2008, Fannie Mae and Freddie Mac in June 2008, and the closure of the Reserve Primary Money Market Fund and several other institutions. However, it was in September 2008 that the crisis reached a critical stage, when Lehman Brothers, considered top dogs then, filed for bankruptcy. This history shows how these events tend to unfold over time, and we should learn from history instead of ignoring what is in front of our eyes. So, reflecting on the 2008 crisis, it developed gradually over a year and 6 months. In stark contrast, our current crisis is just about a month old, and it has already led to the downfall of 5 banks. It's very indicative of what the whole economy is like. So there's this particular situation with the Fed coming in and guaranteeing all depositors, but it's a common situation. It exists pervasively. And what is it that I'm talking about? That there has been a lot of creation of debt to make investments. The frightening aspect is that what we've witnessed so far is just the beginning, and things could escalate rapidly, according to Jim Rickards. He points out that our contemporary technology has the potential to accelerate the crisis much faster than in the past. Here's why. Technology has made things incredibly easy. In the event of a bank run, it can happen in the blink of an eye. For example, if you hear that Silvergate Bank has collapsed and one of their partner banks where you have an account is also on the brink, what would you do? In this situation, your first instinct wouldn't be to go to the bank to close your account. Instead, you'd likely go to transfer all your funds to a secure account. With the convenience of technology, you can perform this wire transfer using your phone in a matter of seconds. Whether the amount is $1 or $1 million, the process is as simple as clicking a few buttons. Unlike the past, when customers had to physically line up at the bank to wait their turn for withdrawal, the dynamics have changed. Now customers can make a run on banks faster than ever before. Here's the deal. Jim Rickards is saying the panic we're seeing now might snowball faster than it did in 2008. Why? Because people remember what happened back then and are already moving their money into safer things like assets. There's a growing sense that the government might not be able to fix things this time around. Right now, the crisis is hitting the dollar itself, and since it's the world's reserve currency, a collapse could trigger a global financial storm. Countries are trying to distance themselves from the dollar. China is pushing the yuan for global trade, and others like Saudi Arabia, Brazil, and Iran are already trading in Chinese yuan. The confidence in the American government is fading. Banks and nations are running out of patience. The result? Banks could collapse, and the dollar might not hold up either. More bank failures are on the horizon, and Jim Rickards thinks the U.S. Treasury will run out of cash soon, forcing them to borrow even more. So the current financial panic is just getting started, and it's likely to get worse. What should you do? According to Jim Rickards, step 1 is to get yourself some gold. Gold has been a safe bet in uncertain times, and even the government seems to acknowledge this. There's talk about pegging the US dollar to a specific weight of gold. To stay safe, Jim recommends going for gold bullion, which basically means gold bars or coins. You can get them online or from local collectors, but be sure to do your research to avoid falling for scams. That's all for today's tips on how to ultimately protect yourself. If you have any knowledge to share with others, please feel free to leave your comments below. Sharing information is a good deed that can help others, just as we've done in this video. If you found the content helpful, don't forget to hit the like button and subscribe to our channel. Thanks for watching.